Yeah, so there are a couple of questions around tech companies and intrinsic value. So Steve says that, certainly there are many situations where traditional measures such as PE or FCF yield may be too narrow a lens to filter ideas. But given today's environment where many tech companies trade at 30x or 50x sales, not earnings, do you think valuations of tech companies may be stretched? And just to add sort of a note to that, Warren says that how do you estimate the intrinsic value of businesses? Most people are using non-GAAP measures as EBITDA. What is your take on that?
Well, I think clearly you can't. I mean, just looking at something because it has a high multiple of sales. I mean, it's suspect, but it shouldn't be. It shouldn't automatically exclude it. I think you have to think about uh, the growth rate in sales, what sales are going to get to in some period of time, and if you think it's 15, maybe you want to bracket that at 10 and 20. But what are sales going to be in 10 years? And then what kind of profitability is possible? You can't, again, you can't just look at price to sales. Um, you have to you have to have some suspicion about what a margin could be. Uh, and you have to apply that to sales and to produce EBITDA and cash flow. And you have to understand the capital requirements and whether the cash flow is free cash flow or not. You have to understand uh, whether the company is now trying to be profitable or suppressing profitability by spending a lot of money for things like R&D and customer acquisition and that kind of thing. So yeah, you have to think about cash flow. I mean, I wouldn't recommend investing in anything without having thought about cash flow. But yeah, obviously, for a company that's newer and maybe unprofitable, you have to uh, enter into some kind of conjecture. And the question is, can you find uh, ranges for sales and margin, for example, that you're comfortable with, or uh, is it really totally unpredictable? Uh, so we're still talking about uh, valuation metrics, but applied to future potential, which is by definition more uncertain than applying it to the present data. Um, and the last question, George, was on what subject, please? Remind me.
EBITDA was Samantha was about EBITDA, right?
Well, look, I mean, we all are faced with EBITDA. It's a good concept if you understand the you can't just look at that because you have to understand what the taxes and interest and depreciation and amortization are, what the needs are, and capital needs and so forth. Um, but I think that adjusted EBITDA is really a bad thing, and one of the most important things for us to do is to de-adjust, because how profitable would my business be if I didn't A, or if I could count on B? It's too much conjecture, and we need a base case for EBITDA, and then we can make our adjustments to incorporate our suspicions with regard to the future.